This is Fritz Meyer for the week of March 24th. I just wanted to look back at the economic data for the last couple of weeks. Let's start here. The JOLTS reports, JOLTS, job openings and labor turnover survey, ticked higher to 7.7 million job openings. I've been watching this chart with a lot of interest over the last few years because the situation has been upside down from the historic norm. In other words, the black line has been exceeding the red line, which has been good news from the standpoint of new job formation. And new job formation is the probably most important monthly economic statistic. To the extent we create more jobs in the economy, we have more spendable income, which drives the GDP. 70% of the GDP is consumer spending. There was an uptick to 7.7 million job openings, as you can see in the black line, and 7.1 million unemployed. The CPI was reported, and good news here, we had a downtick after 4 consecutive months of upticks. The headline CPI, the blue data series, was up 2.8% year over year in February. So that was a positive development. The retail sales for February show a snapback from the depressed number in January. And you may recall me saying that January probably was weather affected. There was very cold temperatures in a lot of parts of the United States. So we saw a partial snapback, and this follows 6 months of very strong retail sales data. So there may be some natural decline there, but I expect retail sales to continue to be rather healthy this year because I think new job formation and consumer spending will remain healthy for the rest of the year. The housing starts data was reported, and here was a very nice pop higher to 1.5 million after 1.3 million last month. Housing starts remain pretty healthy, notwithstanding the fact that Americans are getting used to higher mortgage rates. Historically, economists have always said if you have strong housing starts and strong car sales, which we have, you have a strong economy. So this is one reason I watch housing starts every month. The construction industry reaches into a lot of different aspects of the economy. So it's not just home construction, but spending at Home Depot and Lowe's, appliance spending. And so housing starts is an important monthly number. And here we had a nice uptick. The Federal Reserve met last week, and in the red boxes in this chart, I've identified places in the central tendency forecast where they cut GDP growth forecast for 2025. You can see from a range of 1.8 to 2.2 in December, they're now expecting GDP growth in the range of 1.5 to 1.9%. And similarly, they raised their inflation forecast just a little bit. And you can see those numbers. This is consistent with private sector forecasts, particularly resulting from the tariffs. Most economists believe that you take about 0.5% off economic growth and add 0.5% to inflation as a result of the expected tariffs. The Federal Reserve is doing essentially the same thing here. Now, some people have been bandying about the term stagflation, higher inflation, lower economic growth, or stagnant growth. I'm not a fan of that term because I remember stagflation with a capital S back in the 80s when we had inflation raging over 10% and no economic growth. This doesn't qualify in my mind as stagflation. I'm not expecting stagnation in the economy. I think the Federal Reserve now is too low in their economic estimate for this year at a range of 1.5 to 1.9%. I think it's going to be more closer to the norm, the long-term norm of 2.3%. We shall see. This chart identifies the changes that the Federal Reserve just published with its central tendency forecast. Now let's talk about the economic forecasts. The Conference Board released its Index of Leading Economic Indicators. As you can see here, the LEI declined for the third consecutive month in February. Interestingly, the Conference Board says, as you can see on the right side of this screen, we currently forecast that real GDP growth in the U.S. will slow to around 2% in 2025. So you can see that the Conference Board is higher than those Federal Reserve forecasts I was just talking about. One qualifier here with respect to the Conference Board's LEI, they were severely mistaken in 2022, 23, and even 24 in calling for a recession. They started calling for a recession 3 years ago, a recession that we never had. I take this data with a huge grain of salt, but nonetheless, I think it's interesting to watch their forecasts. The bottom line here is they're forecasting 2% GDP growth in 2025. Further on the subject of economic forecasts, the Atlanta Fed's GDP Now forecast is for the first quarter that's just about to end with the end of this month. They're forecasting a negative 1.8%, and that's up a little bit from almost minus 3%. The Atlanta Fed's number was severely impacted by the surge in imports. I tend to think this number is going to prove to be vastly understated. It's going to be a big mistake. I think GDP growth in the first quarter will be okay. And that's confirmed by this New York Fed's nowcast, dated just a couple of days ago at 2.72%. Wow, that's a strong number. And it's actually an uptick from the 2.69% that you can see on the right side of this page. Interestingly, if you look at the fine print at the top of this page, it says the staff nowcast is at 2.6% for the second quarter. The New York Fed is forecasting a sequence of 2.7% and then 2.6% for the first two quarters of this year, which I think is going to be closer to reality, just because I think consumer spending will continue to drive this economy in a pretty good clip. And I rest my case for continued healthy GDP growth, particularly on new job formation. I keep going back to that first chart that I was talking about, job openings compared to unemployed people looking for work. That's a very healthy situation for the U.S. economy. That concludes this economic summary.
Interesting to see how the New York Fed and the Atlanta Fed are so different.
Yeah, it really is. It's going to be real interesting to see how it shakes out, but we won't know that for another 5 weeks. So stay tuned.
Okay. Thank you, Fritz. That's great.
You're welcome.